Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hi, Kevin Cook here. Welcome to this week's top stock picks. My pick is Illumina. Illumina is the leader in genomic sequencing. This company, you may know them as famous for making the $1 million machines that can sequence an entire human genome in one day. And I wrote a Bull of the Day article that I'll reference here today. Just published this on Monday morning, and it gives a lot of details on the company's business, 32 billion market cap. And when you think about, who needs these $1 million machines for genomic sequencing, well, just about every biotechnology company wants to have a few of these machines. So from your large, big cap pharma to your small biotechs, it's used in agriculture genomics, universities, any life sciences research labs that are doing any kind of molecular diagnostics or consumer genomics have a need for Illumina's processing power. Now, they're in addition to the $1 million machines, they have several other products, and that comprises almost 90% of their total revenues. In 2021, that was the mark in 2021, was 87.7% of revenues. So let me show you a couple more things in this report that I wrote. And you can find this, just go to Zacks.com and type in the ticker Illumina, ILMN, and you'll be able to find this Bull of the Day article. So Illumina essentially has a moat with this business, and I'll explain why in a moment when I talk about some M&A they've tried to do. So the growth here is strong. That's why Illumina has risen up in the Zacks rank, and we're seeing a steady 15% plus revenue growth for this year and next year. Slight drop, or actually a big drop in EPS this year, but it's bouncing back. So, and the reason that you could have a 30% drop off in EPS this year and have it bounce back means that the estimates have stabilized and started to head back up. So, speaking of the M&A controversy, Illumina has been trying to buy a company called Grail that they actually spun off 5 years ago. Grail has a cancer detection model where they can detect 50 different cancers before they become symptomatic. And this would be a nice bolt-on for Illumina to have back within the fold to accelerate access and adoption to these life-saving tests. But the EU has a problem with the acquisition, as just like any antitrust regulator. What's interesting, though, is that, Illumina owned them before, and Illumina got turned down when they tried to buy Pacific Biosciences, which was like the nearest closest competitor in genomic sequencing. They were only trying to buy a small $1 billion competitor, and it was rejected by regulators. Let's look at some of the reaction in July to whether or not Illumina would get to buy Grail. Analyst from Canaccord Genuity, Kyle Mixon, said that he saw it as a net positive either way. Even if they don't get to buy it, it's a positive for the company, and that investors are underappreciate the company's core strong performance. He reiterated his buy rating and a $520 price target. Now, that's a pretty high price target considering the stock's trading around 200. But we're also near the 52-week lows. And so I think long-term healthcare investors are getting a great opportunity to buy the leader in genomic sequencing here near $200. We'll come back to the reproductive markets in a second. I just want to show you, why was Illumina's business such a powerhouse during the pandemic? Well, first of all, they were able to sequence the coronavirus quickly and allow pharma companies to do the research they needed to do with that. And we've just seen this explosion in more needs for genetic sequencing. I call this the century of biology, and Illumina is leading the charge. Now, I always tell people one of my favorite companies is NVIDIA, and I say you got to check the newsroom in NVIDIA every week. I would say at least check the newsroom for Illumina every couple of weeks because there's always something new and innovative going on. Um, this is a story here from July 13th in Business Weekly. This is just where Illumina has appeared in the news. An ovarian cancer pioneer builds on Illumina accelerator success. So you can see how the companies doing deep R&D in the life sciences need the power tools of Illumina's genomic sequencing to get their jobs done. All right, let's go back to my Bull of the Day report here real quick and talk about reproductive markets because this is a really important area. Think about non-invasive prenatal screening. You'll sometimes hear it called NIPT, non-invasive prenatal test, or NIPS, non-invasive prenatal screening. Same concept. And what an important growth area this is for women and their babies to have screening just so they have a heads up about different genetic issues that are imminent or could be on the horizon. Every family would like to know that. Every mother would like to have more knowledge than less, I think. And I own another little company there, Natera, which is a $4 billion diagnostics company that specializes in non-invasive prenatal screening. But again, Illumina is the leader here, and I think you have a great chance to buy it near $200 for the long term. This could be a double in a matter of a couple of years. All right, next up is Shiraz Mian with his top stock pick of the week. Thanks.
Thanks, Kevin. My pick is Dollar General. No need for introduction with the stock. It's currently trading around 250. The Dollar General stock went through some severe punishment over a roughly 1 month period from mid-April to mid-May. There was a time when the conventional brick and mortar operators were releasing their first quarter results, and the stock really took a hit in solidarity with Target when they came out with their sales problem and the inventory issue, which obviously later on got confirmed by the Walmart pre-announcement as well. But in that period, roughly mid-April to mid-May, the stock lost almost 30% of its value. And then in the week after that, or a few days after that, Dollar General reported its own results, and the stock took off. It's currently around 250, but in that 1 month sell-off, it dropped from roughly 260 to around 185 or so. So I have liked Dollar General for a very long time. I hold it in the Zacks focus list portfolio since early 2018, and as you can realize, we are sitting on some very nice gains in the stock. And what I like most about them is this amazing blend of offense and defense. So let me briefly touch on the offense part, which is in essence the growth attributes. It has one of the most consistent growth profiles in the retail space. So almost 30 years of positive comps for Dollar General, even in the Great Recession on a 2-year stack basis, positive comps for them. They have about 17,000 units currently, 17,000 stores. They are the largest retailer based on the number of outlets, mostly in the Midwest and in the South. And management for a very long time has articulated the opportunity of doubling that. They recently announced 3 new distribution centers last week, to be precise, one of them being on the West Coast, And the West Coast is effectively white space, as they say in the retail jargon, growth opportunity for them. So about 6% unit growth for them. That's been the track record, and that's what management is standing behind at present. Um, and then the second growth driver for them historically has been market share gain. And I strongly feel that the current environment, where we are all transfixed as to how the macro landscape will unfold, and consumers are worried about the purchasing power of their wages, given all the pressures they have to deal with. Uh, Dollar General benefits from consumers trading down from their traditional retailers to them. And that has historically been a big source of gain for them. And I strongly feel that the current environment is ideally suited for them. They're also well positioned in the current environment because they don't have the inventory overhang issue, which is such a big headwind for, we mentioned Walmart and Target, but a host of the traditional retail space. They are about 70%, 72% to be precise, based on 2021 numbers in consumables. No apparel. Walmart is about 50% consumables. Target is close to 40%. So the risk of markdowns is either non-existent or very small with them. There is some ongoing headwinds for the entire space. Dollar General isn't immune to that. There's labor pressures. There's the freight and transportation, higher fuel expenses, and that's an issue for all of them. And to the extent they are exposed to that as well. But Dollar General, unlike many others, have been working on over the last 2-3 years on a number of operational initiatives that promises that the margin hit to them will be a lot smaller than is feared for their bigger peers. So, in my judgment, Dollar General is ideally suited for the current environment. I see the stock more as a core long-term holding and not as a tactical buy. It has had, as I mentioned, from mid-May, a pretty impressive run. It's currently up about 8% this year. Walmart is down about 8%, and the S&P 500 is down about 14% valuation-wise. Currently trades a bit over 20 times on a forward 12-month estimates, which is roughly in line with the 5-year median. If we look at the last 5 years, the stock has traded as high as 25 times and as low as around 14, 15 times. But I strongly feel that given all the attributes that I mentioned, the blend of defense and offense, they deserve a premium relative to its peers and premium relative to its own history. I see near term, next 6 to 9, 12 months, the stock moving to 300. I'm not recommending that you take on your full position right away. As I mentioned, it's close to 250 right now. I'll recommend building a small position now and adding to it over time on any weakness, and then holding on to it for the long run. So that's it for me, folks. Dollar General in the retail space, a blend of defense and offense.